3 weeks and my account has risen by like 30%. That's the real account, XTB. And you know, sorry for the mess in the background. It's like 11 p.m. I just wanted to really record something. I'm gonna edit it tomorrow, but okay, enough of that kind of yapping. Let's get to the actual stuff that, you know, brought the stock market to where it is right now. The account value was $173,000. I posted it 2 weeks ago, right? 9 views, whatever. $230,000 with maybe what, 2K in deposits. Let me show you something even more crazy. 3 stocks with 3 stocks with 2x potential for huge gains. 14 views 1 month ago.
Going to be hims and
hers. 33.91. It was before Trump introduced his tariffs. It fell to $25.26. 3 weeks later, it has almost tripled. And now it's been here before. And literally, I explained my reasoning why I thought it was going to come back to the 60s. It was 3 weeks ago and I'm 17 years old, no finance degree, still in school, battling with maths HL and stuff. But it works, and here's the proof, you know. So that's the whole idea for the video. It's been why I thought it was going to come back. You can watch my previous videos, but in general, I just want to lay out the whole kind of theme for what's going to happen. The headlines, literally Bloomberg, stock raised 2025 job as Nvidia powers tech rally. Why? Tariffs. Trump has slashed tariffs, especially on China, from 140 to 10%. We're going to get professional. Just if you had some cash on the sidelines, I think it was the best time to really put it into the stock market. Since it's dive 48.35.04 on April 7th, days after the Liberation Day, it's now up 22%. 22% in 3 weeks, a whole fucking index. And you know, year to date, it's up by 8% maybe. But there are statistics, I can't recall them, but the best, I don't know, 10 days of the market account for 70-80% of the gains. We haven't even gotten to, you know, 6,000 in the S&P. And it was mostly the Mag 7s that were driving it down, because that's kind of what I wanted to talk about later. But since we're here, we're going to try, S&P 500 equal weight ETF. You can see that it has also dropped to 150 and risen by a bit less than 20%, but you get the gist of it. It was a bit more stable than the normal S&P 500 just because of the equal weighting, and companies like Meta or Netflix was positive, but Amazon, I think, dragged it down as well. And you can see seeking alpha sentiment, how recession odds are changing as tariffs policies shift. That's the most important thing, because I'm not sure if you know, I talked about the price. We've also had a lot of negative sentiment, that's quite obvious. You know, the put to call ratio was extremely high a month ago. Right before Liberation Day, I think it was 2-to-1 for puts, meaning, you know, insurance against the stock price falling. So people were essentially betting that, you know, the stocks would fall, and they did in fact, and they cashed a lot of money. They made a lot of money on those options. And you can see that 5910, 5900 basically, 142 calls and 103,000 puts. This is quite bullish, as it is almost a 1.5x, which, you know, it just shows that the sentiment shifts extremely kind of quickly and to the extremes. But that's what you get when, you know, you impose 140% tariffs, triggering concerns about a global recession, inflation reigniting and economic growth slowing down, which then results in stagflation, which is why we ended up at 4,800. You can also see that the CBOE Chicago Board of Options Exchange, I think, was at a record $50. Comparing it to, the last 6 months, or even in the August 7th, August 5th really crashed, it was at 40. Now it was at 52. But it was here for a much longer period of time. It was extended, since April really 2nd for 3 weeks, literally. It was above 30. And you could sense the volatility, and that was when you should have bought stocks, because the fear was at its high. The put options really manipulated the stock prices down, and that's really important. What I wanted to say was that if you'd watched the previous video of mine, you can see that the treasuries have now gone up. The yields really didn't signify any kind of fears or anything, because it was volatile. You could see that the inflation expectations were quite low, and that was because of probably stagflation and the economic growth kind of slowing down, which would affect yields. But obviously you can see that there is a huge disconnect between the stock prices and the bond yields, so the bond prices and the return that they give. So that was one of the more important points made by Tom Lee. While the dollar had weakened quite significantly, it was mostly because of trade balances and macroeconomics as a whole and how it works. That's just the nature of a currency that kind of from being a global currency, the global supply of money, literally going to an isolated kind of thing. But now it's probably going to rebuild its strength, surely because of the sheer kind of deals that Trump is making, because they have signed $600 billion in investment from the Saudis in AI in the US. Nvidia was one beneficiary, and then AMD secured a $10 billion deal, which is more than a whole year of their revenues. And then there are multiple ceasefires in the world right now, so everything is kind of the stars are aligning for Trump right now, because the markets aren't going to be that volatile, the commodities aren't going to be that volatile, which is then going to encourage people to take on more risk, and this just shows that we might have more expansionary moves. So one more important thing right here, the CPI, the Consumer Price Index. It's basically, as I said in the last video, it's a measure of inflation in the US. And regardless of the fact that imports to the US have surged because of, the fears of tariffs, you can see that inflation ticked up really before the beginning of the year, just because people were anticipating tariffs, especially since Trump won and he was bound to win. Really, everybody thought of that, and so naturally prices went up. But then the Fed target is 2%. It is clocked in at 2.33. Okay, we're just going to search for jobless claims, and look at this. While there have been some, tick ups in the jobless claims, it has been more or less stable throughout the year. Of course, there are some spikes just because of the nature of employment, seasonal employment, and geopolitics. You can see that in April it was quite high, and then that's also because of tariffs. That's because of companies wanting to deleverage themselves or de-risk their balance sheets, and so it kind of makes sense. But as you can see, the job market is quite stable. it hasn't really been an issue, although the consensus was a bit higher than, the actual data was a bit higher than the consensus. It's nothing really that bad. Here's the thing: once you combine inflation and the job market, it's looking really well, because inflation hasn't gone up, it has been going down, the job market has been stable, which gives the Fed an opportunity to cut rates. And they didn't want to cut rates because they weren't afraid of inflation coming in. Now, since Trump kind of made the whole inflation story kind of go away, they will probably cut rates, and that's my opinion. So we're going to actually see a boost to the economic growth of the US, and then we have major investments coming into the US. So it's looking really interesting in my opinion. Of course, I'm not an macroeconomics or economics expert. I'll take it with a grain of salt. Of course, I'm not a financial advisor, but as you can see, no, that's not really what I want. As you can see, the yield on the 5-year, well, once Trump got elected, the inflation expectations were sky high because of the tariffs, and wow, even post-Liberation Day, they weren't as high as before the sheer tariffs. And you have to remember that Trump shocked literally everyone with the percentage kind of levels that he wanted to impose on countries. So it hasn't been that bad. Of course, we're just gonna take a look at the 2-year. Like, below 4 is great. We'll see how it kind of moves, but if we could reach the September levels or the April 4th, before pre-Liberation Day really, it's going to look great for the Fed and cutting rates. Additionally, the Fed has an incentive to communicate with Trump because of him being actually quite rational as to what, you can't call the behavior rational, but he knows what he's doing more or less. He knows the consequences that the US would suffer. And to be honest, you can look at my videos back in 2 months ago, 2-3 months ago. I talked about the fact that it was probably a negotiating tactic rather than something that he would really stick to, and it has really played out well for me. Unfortunately, I didn't take any trades leveraged or any of that. I don't feel confident enough, but it has been a great week. It's looking really good for the future. Additionally, if we look at Hims and Hers, I've seen people starting to short the stock really today. But let's look at the short interest. Look, we're at 30% at $64. Everything's flying. Robinhood has a 4.2 short interest, so the percentage of people betting against Hims, in my opinion, is quite absurd. But we might see a correction or a squeeze to the upside, and then kind of a correction, probably retesting the 60s again, maybe falling into the 40s, looking at the simple kind of support and resistance levels. So it is going to get interesting for sure. I can't wait I hope that I laid out a good outlook for the future, or summarized the week really. It may have been a bit chaotic, but I did my best. It's 12 a.m. and I gotta wake up at 7 a.m. tomorrow, so please forgive me.